Hey, thanks for watching my video today. I wanted to talk with you about selling your software company. If you're somebody who has a software company and you're looking to ultimately sell it to an exit buyer, do an acquisition, whatever it happens to be, one of the things you want to pay attention to are some of the key metrics and benchmarks that buyers look for in a software company. So before we get into the individual metrics, I want to talk about the overall goal of your sale. So there's your goals as a seller, and then there's the goals that a buyer will have with your company. Now, it's important to understand the motivations of the buyers when they're trying to acquire your company. Each buyer will have a different motivation depending upon what their long-term goals are. So there's a couple different areas you can take a look at in terms of motivation. There's financial motivations, there's motivations such as marketing and acquiring customer bases and market share. There's doing acqui-hires, so actually buying your team and then integrating them into their overall strategy. So depending upon those individual goals that they have for how they're going to build their company in the long term, they're going to pay attention to certain parts of your business that make the most sense for them. So let's jump into financial metrics first. A couple of the financial metrics that buyers are going to look for in your company are things like revenue growth rate, overall scalability, and the scale rate that your company is growing at, gross margins, net profit margins, things like customer acquisition costs, customer lifetime value, some of the revenue numbers such as annual recurring revenue, monthly recurring revenue, and even some things like your free cash flow and your overall burn rate. So before we go into the other types of metrics, I want to talk more about the financial metrics here first. So revenue growth rate is really important, especially in an early stage software company, because it shows how quickly your company is capturing market share. Now, as you get later on in your company's life cycle, things like net profit margin and free cash flow tend to make more sense from an acquisition perspective because they're more interested in actually generating a return immediately on their investment, so purchasing cash flow from your company. However, early on in the business, that's actually can be a misleading metric if you're just focused on profitability, because ideally what you should be doing is you should be reinvesting the majority of your profits into funding future growth so you can capture more market share quickly. Now, because of that, early stage companies tend to be valued more based on multiples of revenue rather than based on what's called EBITDA, which is a multiple of earnings in the long run. So especially early on, as your company's growing, you want to make sure to fuel your growth rate and make sure that you're doing everything you can to maximize revenue to make it look more attractive to a potential buyer. So the next metric to pay attention to is gross margin and net profit margin. So gross margins, again, tend to matter more for certain acquirers because it's a measure of how profitable your company could be if you actually optimize for making a profit on the business, because gross margin will tell you out of every dollar in revenue that's coming in after you have cost of goods sold and all that, how much money does your business model actually make. Then there's the other things like reinvesting in growth of the company, which will then eat away at your net margin. But once you cut those things out, you'll actually have an improved net margin in the business, which is important if they're looking at more of the net profitability of the company. So talking about net profitability again, if you're later on, you've got 5 million ARR, 10 million ARR, maybe larger, companies may be looking at you to say, how profitable are you? How much money are you making in terms of free cash flow? And then what window does that buy? So they may be buying, let's say, 4 or 5 years of cash flow up front for you in the acquisition. So those are important numbers to look at and also optimize for in the long run if that's what you're looking to do. So next step is customer acquisition cost, customer lifetime value. So these are important metrics because they tell your acquirer what does it take to actually go and acquire a new customer under your business model. Once you have these numbers down, these are excellent because you might be selling to a company who has a lot more financial resources than you do, and they're looking to invest a significant amount of growth capital into capturing more market share. If they know your customer acquisition cost and then also the total revenue per customer that they get, that's going to give them an idea of how much capital can be applied as a lever to grow that business. So if they have 10 times the amount of capital that you do, but they know that number, they can just throw a lot of funding at building out their overall customer base and growing the business from there. So those are important numbers to look at. And again, customer lifetime value as well. What's the total revenue that comes in based on each customer that they acquire? And then what's the actual return rate based on the CAC and the LTV of the customer? So once they invest $1 in customer acquisition, how long does it take them to actually get that dollar back out in terms of customer revenue? So next numbers are annual recurring revenue and monthly recurring revenue. Again, these are similar numbers, but they give you an idea of how much recurring cash flow is being generated from the business, or recurring revenue. This is really important, especially with software companies, because one of the benefits of the software business model is it gives recurring subscription revenue that you can then just milk into the future, and it constantly fuels your bottom line, and you don't have to do any additional work for that. So most software acquirers tend to really value ARR and MRR well. You want to take a look at like how stable is that revenue across time? Do you have long-term contracts? How often is it recurring? Is it quarterly? Is it monthly? Is it annually? And then what's the gross margin on that recurring revenue? And of course, what are numbers such as your churn rate? So then from there, looking into cash flow and burn rate. So this is more kind of like a net profit number, but what's the free cash flow that your business generates? Are they looking to acquire you as a cash cow to go and fuel other things that they're doing? Or are they more interested in doing things like growth and marketing right now? Burn rate's an important number to take a look at too. So like if you're currently losing money, how much are you losing and how fast? What's the total window that you have, the money that you're burning until you reach this kind of like zero cash perspective? But then also like, why is that money being burnt? So if it's invested into sales and marketing and growth, things are going to generate positive future return and expected value. In the long run, those are just important numbers to look at and put into context with your burn rate. So some other things to pay attention to: customer, for example, your customer market metrics. So looking at your customer base, seeing how concentrated is your customer base in certain markets. How diversified are they? Are they diversified across different markets, maybe different geographies, whatever it happens to be? So this will give me an idea of how fragile or anti-fragile your business model is and some of the risks that are involved there. Things like customer retention and churn rates. Of course, these are important to know, like how fast are you losing customers? So how fast do you need to go acquire customers just to maintain an equilibrium of the number of customers that you have, and then of course grow the customer base long term. So market size and growth potential. The more mature your marketplace is, the more you're going to know this number, but what percentage of the marketplace have you captured, and then what's the upside on that? So you might have acquired 0.5% or 1% or 10% of a certain market, but if you go and you do the right things, you're going to be able to acquire a lot more, and there's going to be a lot more market value down the line for properly executing. Of course, things like competitive landscape and market positioning. Who are your competitors out there? What are they doing? What are the key differentiators? And all of that. So customer satisfaction, net promoter score. So from here, how happy are your customers? Do they enjoy your product? What are some of the weaknesses of your product? Maybe with some additional investments in capital or team or whatever it happens to be, maybe that would improve customer satisfaction. So knowing these metrics, things like net promoter score, will certainly help you give an idea of like what you need to add to your roadmap to increase customer satisfaction. So getting into some of the specifics too, things like product and technology metrics, you want to look at your roadmap and say, okay, what are we doing over the next quarter, next year? How quickly are we executing? Do we have a team that can deliver quickly in order to bring new features to market and capture additional market value? Things like technology stack infrastructure. What platforms are you built on? Is it compatible with the technology teams that they have at the acquirer? Is it something where they need to build out additional capabilities to really understand what you're doing? What intellectual property or patents do you have? Do you have anything that's special or unique that differentiates you from the marketplace? Integration compatibility with other systems is a very important one too, because it makes your product sticky. If you tie in with other platforms And now it's going to be that much harder to unplug what it is that you're doing and then plug it into something else. Then your customers are going to stick longer, and that's going to make a much more valuable business. So other things to pay attention to as well, like teams and operating metrics. So they'll look at your team. How skilled is your team? What value are you going to add long-term to their business once the deal's done? How much your employees turnover? Are they happy? That's a huge risk in mergers and acquisitions, is that you do a deal and all of a sudden some of the key team members leave and you're just kind of left with a business that's not functional. So, operational scalability processes, how well defined are your SOPs? Can you go and replace people easily? Like if some people drop out, or even key people, how important are the individual team members to the overall success of the acquisition? Company culture and values alignment is actually a really important thing to pay attention to. It's one of the key reasons that a lot of acquisitions, post-acquisition, will fail, is that the companies actually just don't work well together. So you want to make sure that there is an alignment between your company and their company, so that your team feels happy and excited and energetic in playing into a bigger long-term vision with the other company that's the acquirer. Otherwise, you might run into a situation where people just decide to leave, and then now everything falls apart. And especially if your acquisition is tied to an earnout, that's going to produce a lot of negative financial consequences for you as the seller. So a couple of other things to pay attention to: growth and innovation metrics. So, your innovation pipeline, R&D, like what are you doing in the future that's unique, that what's going to give you an advantage, or the company that's purchasing you an advantage after the deal is done? Time to market, release cycles, how quickly are you moving? Again, how well can you execute? That's an indication of a strong potential acquisition for a buyer. Another thing too is what new markets are you expanding into? What new geographies? Are you international? Do you operate outside of the United States? What's the potential market upside if you do those things? And just to close everything up, look at a couple of other key metrics too. So customer support, service metrics. How good is your customer support? How quickly are you responding to tickets? Are people happy? That's going to play a lot into even your things like your net promoter score and things like customer churn and all of that. So from there, maybe some of the numbers for sales and marketing, you pay attention to those. What are your email open rates? A lot of that. Because a lot of times companies will look in and do a marketing deep dive and see how responsive is your list? Are you engaging with your audience properly and all of that? So all of those things are really important metrics to pay attention to, that a potential buyer will certainly be very interested in knowing and understanding about your business, and determining whether or not you're a right fit for their portfolio, for their company, for their team, whatever it happens to be. So if you have any further questions on that, just drop a comment in the section below and be happy to chat with you further about that.